Dear students, welcome to the e-learning platform. In this video, we are going to discuss about the types of assessment in income tax. I am Dr.S.SAMBATH, Assistant Professor, PG and Research Department of Commerce, St.Joseph's College of Arts and Science, Autonomous, Cuddalore, Van. Before discuss about the various types of assessment, first we discuss about what is the meaning of assessment. Assessment followed in the income tax. Assessment means is an examination. The income tax department examine the return of income submitted by the individual taxpayer for its correction. The process of examining the return of income is called assessment. It means the individual taxpayer they have to file the return to the income tax department within a stipulated time. After the individual taxpayer files return to the income tax department, then the income tax department they can go for the verification or they can go for the examination. That verification process or the examining the return submitted by the individual taxpayers, that examination process is called assessment, right? The next we are going to discuss about the various types of assessment. The first assessment we are going to discuss self-assessment. Self-assessment means the evaluation, the examination made by individual himself, individual taxpayer himself. It means the individual taxpayer calculated the amount of tax payable to the income tax department. It means the individual taxpayer himself he calculated the income earned during the year, and then if any losses that they adjust the losses in the particular allowable income, and then if any deduction is there, if any allowable deduction is there, that also should be adjusted in the particular income. So the individual person himself, he made it all calculation according to the income tax rules, and then he calculated the amount payable to the income tax department. So in this case, all the examination process done by the individual taxpayer. So this type of assessment is one which the assessee calculate the tax by himself. Usually accompanies calculation the payment of amount he regards as a due with the due. The time limit for the self-assessment, there is no specific date for self-assessment, but the payment of self-assessment it should be made it's within 31st July of every year. So the self-assessment should be made within 31st July of every year. The next one, summary assessment. This type of assessment carried out by the income tax department without any human intervention. It means after the individual taxpayer file is returned to the income tax department, then the income tax department go for the verification or examination. But in this examination, the income tax department will not go for any human intervention, but they simply checking the record in the sense they may check the arithmetic error in the return. Arithmetic error in the sense whether the amount they have mentioned in their return, in their filing the return, and then the amount mentioned in the document, whether both are same or any deviation is there, like that they may check. So in this assessment they may check simply the number, arithmetical number, or any claim, any not allowable, any disallowed claim they have mentioned there, and then any disallowable deduction they have claimed, and then any disallowed losses they have claimed. Like that they may check the the information furnished by the individual taxpayer, and then at the same time they check the actual record, what they have filed and what the actual record, like that they will check. That is called a summary assessment. The time duration for the summary assessment, actually the summary assessment should be made by the income tax department within 12 months from the end of the assessment year in which the income was first assessable. Third one, regular assessment. In this regular assessment, the income tax department authorize any assessing officer or any other income tax authority to do this assessment. Right? The purpose of this assessment, the assessee has neither understated or undermentioned his income or overstated any expenses or any not overstated any losses or underpaid any tax. So in this case, the income tax department check whether the individual taxpayer correctly mentioned their income or they are overstated their expenses or they are understated their income, like that they may check. So this examination is called regular assessment. In the regular assessment, if an assessee is subject to scrutiny assessment, the department will send you notice well in advance. However, the such notice cannot be served after the expiry of 6 months. It means the income tax department found any variation, then they may issue the notice to the individual taxpayer regarding the variation. Then second one, the assessee will be asked to produce the books of accounts or any other evidence. While the income tax department examine the return filed by the individual taxpayer, they can ask any information. They may ask to produce the accounts also, or any other voucher or any other evidence relating to his filings return. So the income tax department have all the power to ask information. So if in regular assessment also, the income tax department asks some books of accounts, some evidence or documents relating to filing is written. The next one, scrutiny assessment. In that scrutiny assessment, after the individual taxpayer submitting his return, again the individual income tax officer may assign the income tax official to do this assessment. The taxpayer is informed through the income tax notice. Right? The officer requests information. It means once the individual taxpayer file is written, and then the income tax department take the file and then to check the return submitted by individual taxpayer, and then at the same time they check the actual expenses based on the document submitted by the individual taxpayer, at the same time based on the some other sources also. Not only they checking the document submitted by the individual taxpayer, at the same time you may check the relevant expenses with some other sources also. If the income tax department found any variation, then they may issue the notice to the individual taxpayer. And then not only they issue the notice related to request information or asking any document or asking any books of accounts related to the scrutiny assessment. So the officer himself calculates the income tax payable by the taxpayer. If there is any mismatch between the income and the tax due, the taxpayer can either pay extra amount or receive a refund. In scrutiny assessment, the individual taxpayer is not satisfied about the scrutiny assessment, then the individual taxpayer they can go for the appeal. In this case, they go for the appeal. First, they have to approach the Commissioner of Income Tax for appeal, and Income Tax ITAT. It means Income Tax Appellate Tribunal. Then they have to go for High Court, and then last one they have to go for the Supreme Court. So this is the order. It means Directly they cannot go to the High Court or Supreme Court. First they have to, if they're not satisfied with the assessment made by the Income Tax Department, then first they have to approach the Commissioner of Income Tax Appeal, and then if the problem is not solved in that level, then they have to go to ITAT, then they have to go to High Court, and then last only they have to go to the Supreme Court regarding the income tax issues. The next one, best judgment assessment. In the best judgment assessment, here we are going to discuss in what are the scenario or what are the cases, what are the situations that income tax department they can go for the best judgment assessment. If the assessee failed to respond the notice issued by the department, or if the assessee failed to comply with the special audit ordered by the income tax authorities, or the assessee is failed to file the return within a due date or such extended date allowed by the CBDT. So in this case, if the assessee is not respond to the notice issued by the income tax department, then they can go for the best judgment assessment. In the best judgment assessment, that the assessing officer will check the reality, check the actual income with some other evidence, available in other sources. So in this case, the income tax department they can go for the best judgment assessment, right? In some cases, for example, if you take individual taxpayer's income limit is more than 5 lakh, it is compulsory the individual taxpayer they can audit his income. But if any individual taxpayer is failed to audit his income, in that case the income tax department go for the best judgment assessment. At the same time, if any individual taxpayer not file his return within a stipulated due date, then they can go for the best judgment assessment. So these are some of the scenario that the income tax department they can go for the best judgment assessment. The last one, income escaping assessment. In the word itself, we can clearly understand that individual taxpayer purposefully he tried to escaping his income, escaping his tax, He purposefully cheating the income tax department and he purposefully escaping from the tax. In that case, the income tax department taking the special care to find out the actual income. The assessing officer have a sufficient reason to believe that the taxable income has escaped assessment, then the authority to assess or reassess assessing income. It means once the individual taxpayer file is returned to the income tax department, their income and expenditure is verified with the document submitted by the individual taxpayer. At the same time, in some other sources also, if income tax department they found that if they have found that the individual taxpayer purposefully escaping his tax, he get more income but he is not actually pay the tax, he have some evidence, the income tax department found some evidence now. In that case, the income tax department they can go for this kind of assessment. But this assessment that income tax department should make by the way of issuing the notice assessment within 4 years from the end of the relevant assessment year. Right? The assessee has taxable income but he has not filed his return. It means that person is liable to pay the tax but he is not filed his return. And then second one, the assessee after filing the income tax return is found to have either understated his income or claimed excess allowances or claimed excess deduction. So in this case, the income tax department go for this kind of assessment that is called the income escaping assessment. So these are the normal assessment process, normal examination process done by the income tax department after the individual taxpayer file is returned to the income tax department. So these are the normal procedure followed by the income tax department. Thank you.